I can't change the direction of the wind, but I can adjust my sail to always reach my destination. Jimmy Dean. Welcome to the Guyana Dialogue. I am your hostess, Shamisa Ali, and it is a pleasure to be here with you this evening. Good evening to everyone joining us on Facebook and YouTube. Tonight's topic is development in oil sector and road construction. The Guyana Dialogue is being sponsored by a coordinating council of Guyanese based in the US, UK, Canada, Guyana, and the Caribbean. Funding support is by well known philanthropist Dave Narayan from Dave West Indian Imports. Please welcome my moderator for tonight, Dr. Tara Singh.
Shamisa, and
Our
welcome to our
panelist,
viewers.
good evening, Dr. Tara. Our panelist is Dr. Ganga Ramdas and Dr. Vishnu Bisram.
Good
And
evening,
our
everyone.
Good evening. And our guest tonight is a financial analyst, Mr. Joel Bhagwandin. I think Dr. Vishnu is having some technical problems and hopefully he will join us soon. Dr. Tara, please go ahead.
All right, thank you very much, Shamisa. Welcome to our viewers and welcome to our panelists and our guests, Mr. Joel Bhagwandin. Before I start, I want to congratulate Bishop Edgehill, the Honorable Minister of Works, for the fine job they have done in putting into place the span 9 on the Guy Bridge. I think probably Joel can confirm this. The bridge was completed before schedule. It was an excellent job by the technician, the engineers of Guy Bridge, and the contractors. So we want to congratulate them. It's very unusual for work to be done on schedule in Guyana, and this is done, so we must compliment them. Joel, do you know if the bridge was indeed put into operation at 6 o'clock?
Yeah, that's confirmed based on the latest news that I've seen. I didn't see anything to the contrary.
Okay. All right. So we want to congratulate them. Now, tonight we're going to have a discussion. We can focus. I still believe there's a lot of misconception or distortion of the oil and gas industry. And we'll go through some basic elementary facts. Even people who are supposed to know better, they often distort and twist things to suit their own ideological bias or perspective. So I'm going to begin by asking our guest, who's a financial analyst and one of our bright academic stars coming up in Guyana, Mr. Bhagwandin. First of all, can you tell us how much money was earned through oil to date and how much was spent by the government? And if you have any idea of the balance in the NRF fund as a start to our discussion.
All right, thank you. Thank you for that, Dr. Tara Singh, and thank you to the entire panel for having me again. So forgive me for not having all of the information because I was traveling I came back home yesterday morning, in the wee hours in the morning, so I hardly get any sleep. So today was really my recovery day. And I had some other deliverables to get done for some clients. So I didn't get to check all the numbers, but what I can tell you that to date, and as you mentioned at the outset, that the purpose of this program is to clarify a lot of the misconception. So I want to specifically address the question of what we have earned to date and put it in a broad context. And the broad context in which there is this huge debate. It's a very contentious issue about a contract and so many things. But one has to understand is that the oil and gas industry that we are operating in is effectively a global industry. And whatever we do, whatever happened in this market, it has an impact on the global industry. So, for example, while a lot of people still pushing for the contract to be renegotiated, and a lot of people still feel that the contract should be renegotiated, even though it is an active contract, it is a live contract, and there is no case study. There is rarely any case study anywhere that I couldn't find any where an oil and gas contract of this nature, a production sharing agreement, was renegotiated during at the beginning stages of its productive life. Even the examples that those proponents use, which is Trinidad and Tobago, and say that Trinidad and Tobago Prime, quoting Trinidad and Tobago Prime Minister, that contracts are not written in stone and they have renegotiated contracts. Well, the fact is, um, that is that is not that is only partially correct, because I verified that information by inquiring from a former energy minister of Trinidad and Tobago, who confirmed to me that Trinidad Prime Minister never renegotiated an active contract. They waited for the contract to expire and then they renegotiated the new terms. So that is a little bit of background context. The second point I want to make within that context is that the fact that we have this very favorable, this very competitive, let's use the word competitive, fiscal regime. If one were to do an exercise to examine the developments in other oil producing nations around the world, one would find that all other oil most other oil producing countries have been liberalizing their fiscal regimes to one that is more competitive. So, what that means is, because we have one of a highly competitive fiscal regime, other countries now are moving in that direction because they're competing for the investment dollars into their country. And I can give you a specific example because I studied a few of the fiscal regimes. The United Kingdom, for example. United Kingdom, which has been in this industry, in this business for a long time, and they have had their fiscal regime, which is very strong, very favorable to the government over the last 2, 3 decades. Over a period of time, up to this point, and up to even when during the height of the COVID pandemic, when the UK was in a crisis, still trying to wriggle itself out of that, they would have implemented what they call windfall taxes. And then you see the proponents in Guyana, they jumbo UK applying windfall taxes. Well, I looked at the evolution of their fiscal regime, and it is so competitive. It is even more competitive than our fiscal regime, even when you apply the windfall tax. Because I did the modeling and the comparison, applying the windfall tax, similar regime that the UK has, and applied in the case of Austria and compare the two, we our fiscal regime turned out to generate the higher the higher net take for the government. But you see these, and this is why what I commend our government for keeping the fiscal regime very simple, not too complicated. These countries like the UK, their fiscal regime is very complicated, very sophisticated. So you got to take your time and model it to really understand what is the net take, right? So that are some of the reality within this global industry. In the context of Guyana and what our current production sharing agreement has caused to happen globally with other countries. Now, coming now to the question of, I don't want to say how much we have right now in the fund because I'll probably take a minute to go through the report. But what we have earned to date is, from the time we started to produce to up to the end of 2022, right? Because And this is information that I pull not from the Natural Resource Fund report or from doing estimates that I see some professors have been doing, like the likes of Kendrick Hunt. He does a lot of estimation and he doesn't use the actual data. This is information that I have examined, which is the consolidated financial statements of the local subsidiaries, namely EEPGL, CNOC, and HES. And I have all their financial statements for 2020, 2021, and 2022. And so you could practically do look at it cumulatively, the consolidated for the three subsidiaries, and then cumulatively for that period. And to understand in a simple way, without the sophistication and the technical terms, to understand in a simple way, you you want to look at your net cash flow. Of the net cash flow, how much did we get and how much did the oil companies get in profit? And the result of that, because in 2020 they did not make a profit, it was a loss, and this is accounted profit, by the way, right? So the net take that we have earned in royalty and profit as of the end of 2022 is $424 billion. That's G dollars, right? From a cash flow perspective. The net take from a cash flow perspective that the oil companies got is about 3 billion Guyana dollars. Now, percentage wise, this net take work out for Guyana to 21%, and for the oil companies, it worked out for 0.32%. So when people are saying the oil companies are getting more, you really got to analyze the financial statements thoroughly to understand, because the fiscal formula could be complicated for those who are not accountants and finance professional. It's for the non-technical people. So what is the net cash flow? And that is what we have earned 21% of the net cash flow since they've been producing to date, and the oil companies have 0.32%. Now, why is that? The reason for that is because when you look at a statement of cash flow, there is operating activities, there is financing activities, and there is investment activities. So the net operating cash flow, the net cash flow that goes to the oil companies, they practically reinvest it in Guyana. They redeploy it in Guyana to finance uh, future developments, future projects in the Stabroek Block. So technically, you have almost 99% of the cash flow generated from oil, our oil that we produce, that is reinvested to develop future developments, to keep the momentum, to maximize the earnings that we could get. And 21% of that goes to the national treasury. I did include what we get from local content spend and all of that. I'm keeping it simple just for people to understand, right? And another thing I wanna say is that I could recall in 2022 when Exxon Mobil Global, the parent company, announced that they made $55 billion in profit, 55 billion US dollars. And the US president said, oh, Exxon made more money than God. And then the proponents in Guyana was like, oh, $55 billion. And a lot of that, there was this big, hullabaloo that a lot of that was from Guyana. But the truth is, and no one has to take my word, this anybody could independently verify this, because all this information is publicly accessible. ExxonMobil, the parent company, is a publicly traded company in the US, and so they have to comply with reporting and so on. So if you look at ExxonMobil annual report, those companies, their annual report, which is far, far more comprehensive and has a lot of details compared to an annual report for a public company in Guyana, you will be able to see all the different markets where, and you'd be able to map out, to plot out which countries, which market contribute to what percentage of their profit based on the size of the market. All that information you could pull and you could analyze. So I did that, and because I wanted to know how much did their profit that they would have earned in this market, what did that contribute to their overall global profit? And you won't believe what I'm about to tell you, less than 1%, right? Less than 1%. So the idea that, you know, the what they make in Guyana is used to pay shareholder dividend. They're not even using the money they make from Guyana to pay shareholders. All the cash flow that they generate here comes right back into developing the resources here. So that is, I think that's a mouthful for now in terms of, and I think it's a perspective that has never been put out
Yeah.
there
Yeah.
in this manner.
All right. Two simple questions before I put you on to Dr. Ganga. Royalty is being paid in cash, and or share of profit is being paid in oil. Is that correct?
Yeah, that's correct.
So a lot of people don't know that. So they need to know that. And okay, Dr.
So
Ganga, you have. Go ahead. Go ahead.
as you, Dr. Singh, as you raised that question, before Dr. Ganga take the floor, as you raised that, I want to explain something else,
Okay.
which is a little bit technical but important. I'll put it over simply. It is true that royalty is paid in cash, and profit oil is paid in crude. Now, what a lot of people don't know is that, and I see I'm saying this because professors, not of the caliber of Dr. Ramdas or anyone here, but I'm referring specifically to the likes of Kendrick Hunt. He has been doing this, and I've been responding to him a lot in the newspapers. He has been, rather than trying to get the actual data, he's been doing a lot of extrapolation and estimates. And Kaicho News, take his letters that he write to the editor and make it into substantive reports. So let me explain this as well. When the financial statements are prepared in the local for the local subsidiaries, right? That revenue, they use Exxon would use whatever prevailing market rate at the time to calculate. So it doesn't mean 100% of the crude that we produce. If we produce 100 million barrels in 2022 or 300 million barrels, just using a number, it doesn't necessarily mean that 300 million was actually sold, right? It doesn't necessarily mean $300 million was actually sold on the market. But to prepare the financial statements, they use the prevailing rate to do their calculations to get the revenue. So why I'm explaining this is because if an analyst like me or any professor or anybody who wants to understand this, they would use different rates, different prevailing rates, and if they want to test the financial statements, the numbers for accuracy, you will find that there are some disparities, some variances, some explaining what is the reason you will find that variance. And that is, so the 75% cost oil that Exxon take out our profit oil and their profit oil. Exxon does not necessarily go on the market and sell that crude. Exxon would take it and they either add it to their inventory or it goes to their refinery, right? So I want people to understand that, because if you do an independent calculation, you will find that what we actually get in the treasury is more than if you calculate and you do the conversion from the financial statements. And that is because we actually sell our crude on the market. And the rate that we got per barrel is about $90 in 2022, for example, the average price per barrel that we got. And if you work backwards to see what price Exxon used, for example, to prepare the statements, you'll find that it is less than $90, right? So I just wanted to explain that little bit of technicality for people to understand what really happens to all of the oil, how it's treated.
Yeah. Thank you. Dr. Ganga? Hello, Dr. Ganga. You're
Dr.
muted.
Ganga, you're muted.
Hello, Dr.
Here we go.
Ganga.
Thank you, Dr. Tara. Thank you, Joel. Everything Joel said about the cash flows is correct. I have no problem with that. I tend to look at the contract terms and monitor four things: production, cost, royalty, and the taxes we give up at the customs. That's the duty-free inputs, and also the profits tax, which must be calculated, and Guyana should minister pays by issuing a tax receipt as if the treasury received uh, funds there, but that's not true. So leaving that aside, though, that's how I look at the contract: production costs, royalty, and the taxes that we give up at the customs, and then the profit tax for which we issue a tax receipts. Those are the essential elements. If I want to do further analysis, then I would do like Joel and do net present value analysis and so forth. But for us to look at opportunities to increase Guyana's stake, it requires going into those terms and try to tweak them and have a meeting of minds between the two parties. And that has to be by mutual consent. So the contract is not perfect. We've heard that over and over by ministers and so on, all right, the president and so on. So we need to look at ways we can tweak the terms of the contract and ask for more. So in that regard, I would say, look, Guyana's economy has been growing at a very, very high rate. Now, taxes need to grow in step with that. Otherwise, our fixed fiscal regime would be messed up. We need to look at that carefully. We need to be able to use all the benefits to make sure the Treasury can cover its current expenditures. So that's one of my concern, that we get uh, more from the oil contract. Now, there are avenues to do this, but we have to be creative and we have to have a meeting of the minds and ask the parties to go back to the table and tweak the contract, not to get rid of the whole contract. No, just the terms of the contract so Guyana can benefit and Guyana doesn't land into difficult fiscal situations. So the first thing is about the growth rate of the economy and the growth rate of taxes that we receive. So some things we may not be able to change, but we can go back and seek better terms in those regard. The first place I would start is with the royalty. Prices have been escalating very, very high all around us. So it is not unreasonable because of the change economic conditions that the 2% that we're receiving is really very, very low. And prices and costs have been escalating. So we need to re-examine the practicability, the feasibility, the reasonableness of the 2% royalty. It would not be able to cope with increased costs and prices. So that's the first one we need to address. So I'll let Joel get the opportunity to react to whether he sees an opportunity to increase the royalty rate from 2%, given that costs everywhere are increasing. That's a circumstance beyond our control, and so we need to go back to the table for that.
Okay, so you were speaking about tweaking the contract. Well, the PPP didn't tweak the contract, but they tried to extract it through the administrative arrangements. That's why they have the local content, and that has amounted to over 750 million US so far. because that prevented foreign companies to come and invest in the oil sector. By passing the local content law, it means that all foreign oil companies got to join in partnership with Guyanese firms who must hold 51% shares, have 75% of the people in managerial position, and 90% of the labor force should be Guyanese. So there's one thing they try to extract. They also extract some money for flaring, which was never in the force contract. But I can tell you, as far as contract negotiation is concerned, that will not happen under the PPP. But they have new fiscal terms, which Joel will explain about the royalty. You said the ALDA has been increased in the new blocks that we will let out before September. So let me pass it on to Joel. Joel, can you please address the new fiscal terms?
Dr. Tara, he's on a phone call right now. If you guys want to continue the discussion.
Okay. The new fiscal terms, rather than them, they get currently they get 75%. The new term will be 65%. So Guyana will take a bigger share of the profit there, and the royalty will be, I think, 10%.
Sorry about that, guys.
Okay. Give us an account of the new fiscal terms that has been put in place, the fiscal regime for the new blocks that is currently being put on bid.
Okay, so that's for me, Dr. Singh. Sorry, I had to take an urgent call. Okay. So I want to answer what are the new fiscal terms by responding in contextually. I'm not debating Dr. Ramdas, but put it into context. Respond to some of the things, because I may be privy to some information that maybe the general public, which I'm going to disclose here at this forum, I did in previous forums. The new fiscal regime in the new production chain agreement, in the current production chain agreement, there is no corporate tax, as Dr. Ramdas confirmed. So we now have a 10% corporate tax. The royalty gone up from 2% to 10%. The profit oil remains, right? The profit oil of 50 that remain. And the 75% cost recovery ceiling has been reduced to 65%, which means that we're going to get more cash flow upfront by reducing the cost to share 50-50 profit, right? There is also another, which was not mentioned before by the vice president. You have to read into the details of the PSA. There is a 10%. Dr. Ramdas talk about this duty that the customs duty that some of the contractors benefit from. So there is now a 10%. There is now a 10% duty that they have to pay. Now, one thing I want to clarify, that this government corrected from the previous government with that same customs duty. So you have when you read the production sharing agreement, you have all the tier one subcontractors, tier one contractors, and below all the other subcontractors. They were benefiting from the blanket duty free for bringing in fuel and equipment and whatever, right? But that was a total abuse or misapplication. It was never meant to be applied in that manner. So now, when they come to renew their agreement, it's no longer applied. So that is, it's only applied Exxon, and they have to apply for it. It has to be approved. Tier one subcontractors, they no longer get that duty like how it was applied before under the previous government. So that's one clarification. The other thing that I want to speak to, I don't want to, belabor the point about this renegotiation. The points that Dr. Ramdas was making, if you're to change those terms that he was referring to, you're effectively going to change the fiscal terms, which is effectively renegotiating the terms. And without getting into that debate, there is a stability clause in the production sharing agreement. And Dr. Ramdas is correct that there has to be mutual consent. You're not going to get that mutual consent because of that stability clause. And there is a background to that stability clause. And that stability clause originated from the Venezuela case study when the Venezuela government, under Chavez, I think, sought to do the same thing. They basically they agreed to one term, get Exxon and another co-venture partner to invest their capital, and then they struck oil, and then Venezuela moved to nationalizing the company, and Exxon took them to court and the co-venture, and they were awarded about, in total, about 30 billion US dollars. That 40 billion US dollars rather. Exxon got 10 and the other partner got 30. Um, that the Venezuelan government had to pay the companies. So that's the origin and the background of that stability clause. However, there is still ways in which the government could get more from the cash flow. I want to use this opportunity for the viewers in the diaspora. I've disclosed this in other forums in Guyana, but I want to say this, repeat this here for the diaspora viewers. Now, the government, as you all know on this panel, you have far more wisdom than me in how policy making is conducted within a political environment, geopolitics, global politics, and sensitivities, and all of that. So, what the government can't tell you, there are some things that I could tell you, and not because I found out from the government. This is because I've been privy to this, having been involved in the process, which I'm about to tell you. The first one is the local content. The local content, as a result of implementing the legislation, we're getting about $700 million more. Now, right now, with the current FPA, current production rate, we're getting close to $1 billion annually, right? As we build up capacity, the local content spend will move up to almost $1 billion a year. So from local content, we're getting almost 100%, almost 170 to 100% more potentially, 70% right now, and 100% potentially once we build up capacity, employment, training, and capacity, local Guyanese companies benefiting. That's cash flow in country spend. That is one way. Now, that local content wasn't easy because the oil companies never really wanted it. And they came up with all sorts of argument, and they were disproved. They were disproved, and so, but their concerns were not discounted. All their concerns that they presented, the law was so designed that it has mechanisms in it to allow flexibility. So, for example, the schedule 1, the targets. If you have to make an adjustment to those targets, you don't need to go to Parliament. It could be adjusted by way of a gazetted order, right? That's how it was set up. Then, if there is a particular service there that a local market can, a local company, a Guyanese company can't supply, and they have to go to a foreign company, then the law allows for that. Obviously, if you don't have the capacity, it doesn't mean that you can't take it from a foreign company, but it has. That's why there is strict reporting. But apart from the local content, the gas to shore project was a little bit more controversial. You would have heard the vice president disclosed at a few of his press conferences that since they were in opposition, when he was opposition leader, they were getting briefings and so on from Exxon. And when they got into government, Exxon came up with all the arguments, all sort of technical arguments, why they shouldn't go to a gas to shore, do a gas to shore project, and they need to re-inject the gas into the wells and all sorts of other technical arguments. The government didn't buy those arguments because the government was shrewd enough to solicit independent advice from other persons, and they insisted that the gas to shore project go through. But it was not an easy task. And here is what Exxon did. So I was working with a global firm. I'm not going to name the firm, but I was working with this global firm, which is one of the big fours, which has a Houston office where Exxon office is. And Exxon Houston, the parent company, is a client of this firm. And Exxon, at one point, hired this firm to lobby the government because they weren't getting through. So they hired this global firm to lobby the government against the gas to shore project. Now, I was working at the firm they have an office in Guyana at the time, and I almost got fired because when the Houston team was trying to get an audience with the government, they had to come through the local office. And when I recognized what they're going to the government for, I said, no, no, no. They wanted to do two things. They wanted to help the government craft a development plan for the country. I said, no, we don't need y'all to do that. And the second thing was, which was their primary objective, was to lobby the government against the gas to shore. I blocked them from, they didn't even get a meeting because of me. To the point where the people asked me, the Houston head office asked my local regional principals whether I'm working for the government or I'm working for this company. And I said to them, well, listen, I don't care. I'm Guyanese first. I'm sharing this with you for people to understand that government may not be in a position to tell you the challenges and the difficulties they have behind the scene. People think all sorts of things go on there if you listen to Glenn Lal. But I just happen to be privy because I was involved in this process from that end. I don't know what else the government have to put up with,
Yeah.
right? And that gas to shore project is going to bring to this country, when you do the economic impact in terms of energy savings, manufacturing sector, household savings, and I work the numbers, it's about another $1 billion a year. So these two projects alone, though it is not directly money going to the treasury, but indirectly it is money coming to the country to impact the country directly and its people, another $2 billion a year. And that
Okay,
we have to appreciate.
okay, Dr. Tara, can I say something now?
Go ahead.
We have a contract with three partners, Exxon and Hess and the CNOC. That's where we have a contract. The child corporations, that's the local service companies that come downstream and provide services. We don't have a contract to give them the same tax benefits as the parent companies, as those three major uh, parties that we have a contract with. So, do we give the local content companies, those service companies, duty free at the customs, and then at the end point, uh, zero profit tax? That is an opportunity for Guyana to collect a fairer share from the local service companies. That's a big opportunity that needs to be explored. The second point I'd like to make, inside the main contract, the 2016 PSA, there's provision for what is called force majeure. So if something occurred, say to affect the main partners, they'll come back to the table. Similarly, Guyana can ask to go back to the table because cost escalation and inflation will definitely affect Guyana. And so Guyana would need to reassess its fiscal finances on account of inflation and ask to raise that 2% to a higher level. So those are my second
Okay.
point.
All right, Joel, you want to respond?
I didn't quite understand. Could you repeat back what you were
No,
saying about
he,
inflation?
he's
The
saying that
prince,
the local companies, the local
No,
oil
I
companies,
get that part. The last point he made about
to
inflation.
renegotiate the because of inflation, etc. You make a case that you need to renegotiate the royalty because of escalating costs, inflation, etc.
It's it's a it's a complex issue, and there is not enough time for me to advance all the arguments. I didn't come here to debate anybody, but here are the arguments, right? I already given you the net take that we have gotten from cash flow. Oil price is volatile. Oil prices go up and down all the time, inflation aside, right? So you're gonna make a case to raise royalty rate based on inflation, but you have prices jumping up and down every day,
those are
right?
windfall
Then
gains.
no windfall gain. So what happens when the price fall below $30? Right? Nobody knows. There, and you got to understand that this industry, the life of the industry, spans 30 years, is about 40 years actually.
We
It
can't
took 15
speculate
minutes.
on
No, no,
that,
no. We're not
Joel.
speculating, it's facts. We're not speculating, it's facts. So here are the facts. It took 15 years to explore from 1999 to 2015 to, to deploy capital all the time before a commercial discovery was made. Then it took another 5 years to develop the resource before they started to produce a single barrel of crude. So
Oil,
20 years, so 20 years later, then you're producing, provided that you find commercial oil in commercial quantities, then the production license is for 20 years. Then you have the economics of the field, the economics of the field when the production would start to decline. So it's a curve, right? Then there is oil price volatility. Then other countries are competing and liberalizing their fiscal regime to compete for investment dollars. So we have to compete with a within a global environment, right? And then, so investment security is important because when we can start to change contracts like that, then it sends the signals to investors as well. And
Yeah,
there's so many dynamics, there's so many
yeah.
dimensions
yes, and that's
to
why
that
we have
argument.
capital recovery. They get every cent back. No shareholder or director puts a penny from their own money. It all comes from Guyana's resource, from
Mm.
Guyana's oil. It pays for everything. So they need to go back and understand that Guyana pays for everything.
Yeah.
So
Okay, but if the oil was there, Guyana and had a capital, couple $1 billion to invest in it, and for people to make this a huge sacrifice, there got to be a cost to that, and the cost you're paying. Now, the
The,
contract
uh,
with
the opportunity cost to that, Dr. Tara, is already factored into the capital recovery. They may even have
listen,
capital recovery
listen,
on stones.
the existing contract in 2016,
Anything that has a life of longer than 1 year. I
yeah,
worked with AT&T in the capital recovery
okay.
section,
So
eh,
and I
if I may,
understand
so
those
if I may ask
yeah.
this
processes.
question,
Hold
could
on, hold on.
Ramdas give me one
Dr.
example
Ganga,
of a
the
yeah. So
2016 agreement, there's a lot of talk. Yes, it's theoretically you can renegotiate, but because of the stability clause, that precluded. Now, that contract was negotiated by the previous government. The PP made it clear it's lopsided, etc. But they have gone into this contract. You got to look at other psychological factors too. They want to create a stable investment environment. You don't want to go into a contract, then you go back and draw back, and you're going to affect other investors because if you can change one contract, you can very well go and change the others too. Now,
May I address that?
mutually agreed, yes, but as Joel said, that will not happen. The government has made it clear And I don't think that we can go beyond. You can express your views as an individual, you have a right to, etc. But the
So
government will not negotiate the 2016. They have made new provisions in the new contracts, PSA, that they put out on bid, and that is what they will do.
Okay, may I address that?
so
Yeah.
Here are the material aspects to that. The 2016 PSA is a production sharing contract, and we know what those percentages are: 12.5% for Guyana, plus 2% royalty. The same thing for the companies, minus what they pay in the royalty, according to the tax IRS
Mhm.
person. Okay, so those are fixed. The the percentages of that are applied are to calculate the taxes that should have been paid to the treasury, but the Guyana minister pays that.
Mhm.
That's the role of those stability clauses in under section 32, that
Mhm.
they don't want that to change. But that doesn't put any money into Guyana's treasury. It's just to calculate the profits
Right,
taxes
right.
and then calculate it and then issue a tax receipt. That's the role in the financial model under the 2016
Right,
contract. It doesn't
right.
do anything else. Guyana's share, after it gets it, it can do whatever Guyana wants with it.
Go
Yeah,
ahead,
well,
Joel.
that's
Dorothy?
okay. I decided, but that will not change. The new contract has different fiscal regime,
Well,
but
we pray that
so
something would
let's
happen.
Dr. Singh, let me, Dr. Singh,
I want to
if I
I
could
want
come
to
in here.
we run out of time. I want to move on to withdrawal from the NRF funds, because there's a lot of speculation about that too. That how the government is running that dry and etc. There is nothing left for the intergenerational equity. And so if you can comment on that, what type of
Yes.
control they have, or what accountability measures, etc. Dr. Gaga will proceed with this conversation later on in another forum, but
Okay.
let's move on. Go ahead. Go ahead. Sure.
All right. So let me address that your last question. Let's start with the withdrawal rules and the accountability, right? Before any withdrawal could be could actually be effected from the natural resource fund, that sum has to be pre-approved by the National Assembly, right? And that pre-approval is by way of the national budget process. Sorry, give me a minute. I'm in between screens here. Yeah. So that's the first thing. And the withdrawal rule is very simple. The formula, rather, is very simple. Anybody could calculate it. And if you look at the budget speech, if you don't want to calculate it, the budget speech has an appendix attached to it. And you would see the withdrawal for the fiscal year as well as indicative withdrawals for the next 3 years, right? Projected. Now, so that's the first thing to understand. The sum is pre-approved by the National Assembly in the budgeting process. For the 2023 budget, the withdrawal from the fund to finance the budget represents 25% of the total budget. So the budget is financed from different sources. NRF, 27%, the organic tax revenue, and other non-tax revenue, the carbon credit, funds from the carbon credit, and the difference comes from borrowing from the domestic market as well, external. So that is the size. That is the size of the withdrawal and the procedure in which it is done, right? And then once it is approved, it is not done all at once. So the budget is approved in January, and then in March they're going to withdraw $1 billion from the fund every quarter. And if you will see this in the natural resource fund report, which is published, which the Bank of Guyana publishes a report every month. They publish a monthly report, a quarterly report, and an annual report, so everybody could see the balance in the fund, the investment, the interest earned, and withdrawals. So every quarter they would draw down, I think it's $600 million, which was already pre-approved. So that's the answer uh, to that question.
Okay. I want to go to Dr. Ganga to give us an update what you think about the current on another topic on the road construction. The government has so far built over 2,500 roads. They call them community roads. Plus, they are building a number of highways.
Well,
What are your thoughts on this? And
yeah, the main things are the zoning laws. Um, we need to have a blueprint so that we can classify these roads, the roads that are highways versus the street roads that pass through villages. We have to be clear about those in order to minimize accidents and so forth. The other thing is we are using the roads also as an instrument of development policies, and that means we have to be mindful of our land use zoning laws. So, for example, let's give an illustration. When we had the railways, the government owned that stretch of land all the way through both sides of the rivers. That was government property. Now, people took advantage and made a living and supported their families by building shacks on both sides. These days, we have a situation with squatters, and that's creating a social problem. So, what we need to do is to set aside lands for entrepreneurs, small time entrepreneurs, not the big 20 acres, 10 acres, and so those big farmers. So we need to publicize our zoning laws, identify the opportunities for starting new businesses and especially farming on both sides of the highways. So the zoning and blueprint for that is needed. I recall that some Surinamese wanted to do inland fishing and shrimping in Guyana. Then I was in Washington, so they asked me to go and see what's available. When I went to the lands and mines, there were only 39 acres available behind the old Atkinson Airport. I was surprised. I know that area because we went searching for creeks inside that area. And when I asked the question, do they have streams of water nearby? Lands and Mines could not give me an answer. They said I have to do my own surveys. By that time, the investors got discouraged and they went elsewhere. So we need to know the characteristics of the land and the likely people who are going to develop the land. So I would like to see a land register so diaspora people and others, those at home, can apply for the chunks of land that is there. If we don't have this information, they wouldn't know what to do. They wouldn't be able to feed their kids and so on. So
Okay.
that's the overall perspective. We
Okay.
need to zone and have a register and let people know what the opportunities are.
Okay. The government is supposed to prepare a national transportation plan. We were told that is in progress and it should be available soon. And that will give a good map about the strategy, and because you got to combine road with river transport, air transport, etc. And there's a plan. which they don't have in writing, but they say they have it conceptually. They're drawing from various sources, etc. But what do you think? What do you have heard about the type of roads that they're producing, the quality? What about the quality quality control of these roads? We've been told some of them break up very fast. Um, I mean, roads in New York City, they build it after a couple of months, they break up too. So I don't know. You have any comment on that?
Yeah, we need inspectors. That's the thing. In the states, New York, Pennsylvania, and so on, you have license. That's one type of inspection, license, and then you have inspections. You have two types of people, two different set of laws applying to these two aspects, license and inspections. We need standards. We need to have performance auditing standards for roads. I've been to all of the construction sites. I've taken in every mode of transportation from forklift to battleships.
Mm,
I've taken students there, all pipelines, dashboard, viewing everything. So
mm,
I understand that. And I was the one who complained to Chetty Jagan about the construction of Main Street Road, how they were using old mayor and town council equipment to build that thing like a Parata roti. You don't build roads like that. You have to go down in the depth, put the foundations like the
yeah,
old Romans and put blocks where you can. There were
yeah,
times in where I live when the city doesn't build a road, I go and break it and put my cords and tapes around, and I build it myself. And I do a
okay,
better job than I see on the seawall that's flaking apart. You
yeah,
have to use big rocks and foundation and build upon that.
yeah,
You don't build on
okay,
the sand
all right.
or mud.
We run out of time, Dr. Gang, but your final thing, there is some idea floating around that they should form a rail link in the East Bank corridor. What do you think of that? That is your neighborhood. If you can make it a little quick.
I didn't quite
I
get it.
didn't quite
Rail,
get it. Sorry.
rail transport.
Oh, rails.
Rail transport on the East Bank corridor.
Rail transport is so essential. If you look at the cost curve for Lamborghini and other vehicles, the cost curve will be going up. For trains, the per unit cost will be going down. If an alien comes to this planet, they would predict, oh, these guys should be using lots of trains because the cost curve is going down. But
Mhm.
it's not so. We need to go back to the drawing table and have a national multimodal transport, including pipelines
Yeah, okay.
and so on.
Thank you, sir. Over to Shamiza. Over to you.
Thank you, Dr. Tara, Dr. Gangaramdas. Thank you both. We will now ask Joel for his closing remarks.
So I will take my closing remarks to make a few quick comments on some of the things Dr. Ramdas said. In relation to land, what I can confirm from where I sit is that that sort of provision is being made. And additionally, you don't need to wait for a register to be published for people from the diaspora to apply for land. People from the diaspora are applying for land every day. And I know that because part of the application is you got to present a proposal, a business proposal. And a lot of people from the diaspora come to me to help them with that aspect and prepare their proposal. So I can tell you that, confirm that for a fact. Secondly, lastly, rather, with respect to the rails, what I can tell you is that the plan to reintroduce rail didn't start today, or it didn't start from when the president announced it. It was there in the planning since 1994, when the 1996 National Development Strategy was being developed. That strategy took 2 years, which started in 1994. You would know this better than me, since you had the privilege to deal with for the late Chetty, well, it was done under him. So that study indicated the feasibility studies to reintroduce rails. And so that's one thing. And the other thing in that respect, I can tell you that I was part of a team. I was part of a huge team with engineers and so on, to prepare some feasibility studies for some of these very roads that we're building right now. Um, and through my exposure with that team to work on that feasibility study, I can tell you again that there's a lot of planning for the next phase of development for rails, where in the current planning where they're cutting roads, where they're cutting land, where they're moving what, they are already making provision to leave, make provision for where potential railway track would run. So that planning and all of that it is already being done, and from a long time at a technical level. So those are my closing comments, and thank you once again for having me on this program.
Before Shamisa comes on, I just want to let you know that our next guest next week is the Minister of Agriculture, Honorable Zulfikar Mustafa.
Okay. Thank you, Joel, for your closing remarks, and thank you for taking the time to be here this evening. To all of our viewers, thank you for taking the time to join us this evening. Until next time, I am your host, Shamisa Ali, and this is the Guyana Dialogue. Good evening, everyone.
Thank you, Joel. Thank you, Dr. Ganda. We'll talk